Let's get more into the markets now and the charts with Tony Sycamore from IG, who joins me. Great to see you. So we are looking very closely to the end of this government shutdown, but there was some concerns again about AI valuations.
Yeah, those concerns which we saw surface last week have re-emerged overnight. And what it did do was prompt some rotation out of those high-flying tech stocks into your stocks which are more leveraged to the government reopening and potential Fed rate cuts there. So your cyclicals and your blue chips did very well there. Now, where it's left the Nasdaq is still in a little bit of a flux here. It had a look below the trend line support coming from the April lows on Friday night, and then it's springboarded higher in the early part of this week, but just continuing to trade around that support from that trend line. Below there, you've got the Friday night low of 24,600 and then a low coming in around 24,200. So for me, given the climate, concerns over accounting, all types of metrics which are overblown on valuations, etc., there's still scope for this Nasdaq to potentially have a pullback. But we've really got to break below that support coming in around 24,600 to 24,200 to really give us the idea that this 10 to 15 to 20% pullback, which some have been looking for a while now, is underway. And until then, the uptrend, as you can see, remains in place. So there is scope for a rebound up towards 27,000. We do see these fears come and go very quickly. Whether it turns out to be a more prolonged episode remains to be seen.
Yeah, absolutely. What about our market? Because, of course, yesterday very much impacted by what we saw with CBA. Today, we're a little bit higher.
Yeah, after those run of new highs in August, September, it has been rather disappointing for the ASX 200. It slipped below that trend channel support you can see last week. And actually yesterday, the rally up to that 1 week high fell just below that trend line resistance, which was support previously. So for me, the actual bounce has been tepid. I'm not particularly inspired by it. I would need to see the ASX 200 get above that 8,900 area to really start to feel that it has returned to a surer footing. Until then, I think you've really got to watch this 87.30 area. You can see it's been a point on the chart a number of times over the past 3 months. And if it was to break below there, lo and behold, I think the next stop is 86.30, potentially down to where that 200-day moving average lies around 8,500. So at this point in time, watching 87.30 very closely, it needs to hold.
All right. What are we seeing when it comes to the Aussie? Because, of course, this week it is all about the jobs data.
I'm very happy with the way the Aussie's traded, actually. I mean, it's been very constructive. It held the 200-day moving average support, held the August lows, and it's bounced back up towards 65.40 yesterday. As you mentioned, we now look towards that jobs data. And what I did note in my morning note is we've now seen the UK unemployment rate rise to a 4-year high. Over in New Zealand, we're at a 10-year high. But lo and behold, here in Australia, we're looking for the unemployment rate to ease from 4.5% to 4.4%. So it would be bucking the trend with what we're seeing in some of our global peers. Nonetheless, if we were to see that unemployment rate drop to 4.4%, maybe 20,000 jobs created, it would probably give the Aussie the green light to trade back up to that band of resistance. It has struggled with 66.20 to 66.30, has capped rallies in the Aussie for the past 6 weeks. But if we do see a 4.5, a 4.6%, to me, it brings the RBA back into play a lot sooner than what is priced, and we could retest that support coming in around 64.50.
Okay, let's get into commodities. You know, there's a lot of worry about what the oil rebalance is going to look like next week, but a third day of gains ahead of the likely end of the government shutdown.
It's positive for crude oil. It really is. The fact that we're going to see this reactivation of economic activity, flights returning to normal. There's 2,000 flights a day being cancelled in the US every day. It does support the price action we're seeing here in terms of the third day of gains. Now, I am looking at this chart, and firstly, you can see the yellow line there, which is year-to-date lows. It's bounced away from there. The second thing is there is an inverted head and shoulders bottom with the neckline coming in around 62.50 to 63 cents. Now, if crude oil can break above that 62.50 to 63 cents level, I think it's very, very constructive for a push up towards the 200-day moving average and highs we saw up around $66 just a few months ago. So watching very, very closely now for this crude oil move to continue higher. And if it gets above 62.50 to 63 cents, I really like what I'm seeing.
And it's also positive for gold, the reopening.
Well, it is. I mean, it's probably, I think the bigger driver of gold at the moment is the fact that the labour market data, the tier 2 labour market data has been soft. Consumer confidence last week was soft, and it's brought expectations of a Fed rate cut in December back into play after that hawkish FOMC meeting just a few weeks ago. So overall, gold, I mean, the rebound has been impressive. I'm not really I don't really have a strong view, I should say, with where it goes from here. I could see it take another leg lower down towards 3,600. Equally, I could see it retest that 43.81 high. But the disputed fact is the uptrend is strong, and whether you get that pullback towards 3,500, 3,600 remains to be seen. But if it does, I like buying it down there.
What about digital gold?
Well, some trouble again for digital gold overnight, Jules, and it's been pretty ugly there. And a lot of things just haven't gone right for Bitcoin in terms of the driver up to that $126,000 high in early October. It was the start of the shutdown. So we have that being negated now with the fact that we're likely opening up the government there in the next 24 hours. And the other part is we're seeing some of the big ETF flows actually going out of the market, which is certainly weighing on sentiment. So I look at the decline from that 126,000 high, and to me, it does appear corrective. But the question is whether the correction is complete or not at that 98,000 low. And the jury's still out for me unless it can get back above that 200-day moving average, sitting around $110,000.